Bill Hench, he's a portfolio manager. We've also got Tom White in studio, is going to do some trading here on our sector talk in a moment. Bill, great to have you on the program. Let's talk some healthcare because your guys' fund is beating the Russell 2000 so far year to date. Has healthcare been a part of that, or is this going to be the next phase for outperformance?
It has been a part of it, and it'll probably be a bigger part going forward. The group as a whole has come down in valuation, and mainly I think probably the bigger caps have led that move down. Concerns about what's going to happen with the election, with what type of healthcare we will have in the states, has led to some multiple compression, and that's moved on down to the small and the micro cap area.
What's interesting is a lot of folks view sort of biotech, smaller healthcare as kind of being a higher risk growth type stocks, but just kind of looking at IBB as a benchmark real quick for biotechs, it's taken off the last month and a half. Even though the broader market has been doing this kind of value rotation, or at least flirting with it, all of a sudden some of the small cap healthcare stuff is just going AWOL and it's going higher. Any thoughts on why, Bill?
Sure. Well, the biotech has been doing well for two reasons. One, a lot of the products are working, most importantly.
Yeah.
And secondly, there's been a very good appetite from the larger pharmaceuticals to make some purchases down there. That's probably not going to be an area. Well, I could say it's more than probably not. It's not going to be an area where a fund like ours would spend most of its healthcare dollars on, because we tend to have names that have lots of revenue, lots of book value. And the biotechs have lots of book value, but not so much in our market cap. So they have a lot of sales, revenues, products, and things like that. So we'll stick mostly with diagnostic companies, with service companies, people who can help, for lack of a better definition, bend the cost curve down and make healthcare more affordable or more user-friendly. And that's where we're going to get the benefit of what's happened with valuations.
I look at some of your stocks here, and they do look like a lot of them are tied back into the existing health system, whether it is facilitating sort of higher margin operational issues at hospitals, et cetera. I mean, that's really what it's about, right? Kind of similar and analogous situation might be for how folks view some of these software companies as making companies and businesses more efficient, right?
Exactly, and even another case would be what's happened with energy, right? If you look at the cost curve on getting a barrel of oil out of the ground in the U.S., it's been tremendous. If we ever had anything, halfway as good as those results in healthcare, you'd see some significant benefits not only to the economy but more importantly to the consumer of healthcare.
Yeah, let's talk about a few of your companies here. RCM I think is pretty interesting. Tell me what's going on here. Revenue cycle management company. That sounds basically exactly what we're discussing here, but also tie into actual physicians, businesses, and doctors as well.
Sure. So anyone who spends even a small amount of time looking at the healthcare system in the U.S. Knows there's a lot of middlemen, knows there's a lot of paperwork, believe it or not, a lot of regulation, all the things that make it much more expensive. And what RCM does is simply, you could call it revenue cycle management, billing, administrative works, things to sort of, clip some of that expense out for the providers. And with that, you could get better service and cheaper service, right? So that's the benefit here, right? Most of the names that we have in healthcare are letting someone do something not only in a more economical way, but also letting someone make a little bit more money by doing it that way as well. So there is an incentive for these things to happen as well.
What's interesting for some of these is that they still don't generate bottom line earnings over a 12-month period. I know some of them are on the cusp of turning profitable, Bill, but we saw earlier this year, and maybe that's why a stock like RCM, slipped in the summer. There was this fear, I think, that spread most obviously through tech companies around the WeWork stuff. People said, hold on, is my company making money here? And a lot of these stocks dipped while the rest of the market was doing well. RCM has come back. Another name that you've got here, SGRY, another company that still on the verge of profitability. So is it important to see them turn positive on the bottom line soon?
Sure. What you really want first and foremost is the model. Does this thing make sense, right? So you'll sit down with these companies, with these management teams, and say, okay, I understand that you're going to burn some cash to build the business. You're a relatively new company or even a new concept. What's the turning point? When does the cash flow turn positive? And those are all incredibly important dynamics when looking at the business. I don't necessarily think a lot of these are unproven models, but they're just young. They're in the beginning stages of what we hope to be a pretty long runway of success. So a company like Surgery, where they've done some acquisitions and sort of are looking much more into the future for profits versus maybe next quarter or the quarter after that. And if it's a reasonable expectation to see that, we're going to stick with it.
Healthcare, 12% up from the latest breakdown I see of the Royce Opportunity Fund, of course, which you manage. So there's a comparison here that I think is interesting too when you consider the average market cap size. About 800 million is what I see for the average size of companies in your guys' small cap approach. How important is the overall small cap market? I mean, is there a close factor tie here where the fund is going to trade next to the Russell 2000, or will it be able to withstand even dips in the Russell? Because right now it seems like the Russell is like this day-by-day basis where if people feel strongly about the economy going forward and the trade stuff, it does well. Days where we've got lower rates, it doesn't do as well. Sure.
So traditionally, this fund in the about 20 years that it's been with Royce, and I've been a part of this for about 17 years now, we've done well when you've got economic growth, when you've got a plus sign on GDP. Those things tend to really help our fund. Most of the companies that you'll find in our portfolio are turnarounds in some way, right? So they're traditional names that have these value statistics when we buy them, but quite frankly, what we're really looking at them is to see, can they provide growth going forward? So if you've got a GDP number that has a positive sign on it, that should do well for us. In a recession, like a lot of other small cap funds, very, very difficult for our fund to perform.
Okay. Bill, really good stuff. Appreciate the insight into the fund. RYPNX is the ticker. Bill Hench, portfolio manager at the Royce Funds. Let's do some trading here with Tom White in studio. Thanks a lot to Bill again. Thank you, sir. All right, Tom. So there's this fund for those that want to go with the stock picking approach. How about if you want to get a broader exposure, just trading, say, the rebound that we've seen in XLV or something like that?
Well, if you look at XLV, it's underperformed the overall market. It's only up about 16% year to date because of the things that Bill mentioned. Yeah. A lot of the regulatory issues, potentially some political issues that have held this sector back, even though it's doing relatively well. Valuation's starting to get a little bit low here. Just hit its all-time high, though.
Yeah, it's taken off right now.
It has taken off the last several months. You've got J&J, UNH, the big names.
How do you ride the wave?
So I just created something using options in a short-term basis, about 39 days to expiration, going out to the January cycle. And you're buying the 101 strike call that's just out of the money to the upside. Stock's trading just below 101, or the ETF is. And then you go out to finance the purchase of that bullish call. You sell the put vertical in there, and that's the January 99.97 put vertical. And you're paying roughly about an 85-cent debit for this three-legged spread here, Oliver. Break even, about 101.85 to the upside, so just about $1, a little over $1 higher than the current share price. But you do have 39 days in this. And I like to set up on a trade like this if you're bullish, because you still have risk to the downside, but you limit it by selling a put vertical to help pay for the purchase of that at-the-money call, which is the 101 strike call. So using a short put spread to help finance a long call for that bullish trend to continue.
Okay, and you're selling the 99.97 strike put, so you can obviously help mitigate the cost there. That's the point.
Yeah, you collect a credit on the short put vertical, but then the key thing here is, Oliver, if we do get a breakdown, market turns south. We've got some big news coming out December 15th as far as tariffs go. You're protected to the downside, and I think that's a key here, while still taking advantage of upside if the ETF continues to move higher.
Okay, let's talk about IBB. Big run lately, as we were just talking with Bill. I mean, just went vertical. So we got the bullish XLV trade. What about those who are looking at this and saying, you know what, this is a short-term thing. There's too much too fast. How would you more take a neutral approach?
Well, on this massive rally, the shares of IBB are up about 26% year to date. So it's starting to outperform the S&P 500. RSI is getting up there, so if you look at it on a technical level, it's kind of overbought a little bit.
Okay.
But if you want to take advantage of, maybe it starts to stabilize, consolidate near some areas. Volatility, implied volatility, really low in here. So I immediately looked at the option market and
You're going to own the options in this case?
Yeah, you do want to own one section of the options, and that's the longer term. So I just looked at a quick short-term trade, 39 days, buying the January 120 puts, selling the December monthly 120 puts. You're paying roughly about $1.45 debit for this calendar spread, Oliver, and you're buying it. So the amount that you pay is what your risk is on that trade, but it gives you a little bit of a wide range for this ETF to trade in to become profitable on this trade. 116.70 to the downside and about 123.5 to the upside. So you've got a nice wide range for it to start to consolidate in. You get to take advantage of rolling your short option week to week to collect some credits, reduce risk, and increase potential profitability on a trade like that. But low volatility environments, buying calendars, not a bad way to go. Just take your assumption on where you think the ETF or the individual stock's going to go and place the calendar at that strike. I think that's a key thing. And you've got a duration of about 39 days on this short-term one.
All right, nicely done. Tom White with the XLV IBB Trade. Thanks again to Bill Hench from the Royce Funds for talking stocks with us.